Tax havens explained. As of June 2025, the UK is experiencing its highest tax burden in over 70 years, surpassing levels last seen in 1948, when taxes reached 37.2% of GDP. Back then, the high tax rates were driven by the need to repay vast World War II debts, rebuild the nation, and fund the newly established welfare state, including the launch of the NHS. Today, British workers, whether earning £25,000 a year or £500,000 a year, are facing the highest levels of taxation seen in over 70 years. The system may seem broken to most of us, but for the ultra-wealthy, it's working just fine. In fact, better than ever. In this video, we explain how tax havens work in 2025, the countries individuals are using to dodge their tax bills, and why even AI startups and crypto billionaires are cashing in on global loopholes. Let's break it all down. What is a tax haven? A tax haven is any jurisdiction that offers foreign individuals or businesses little to no tax liability, along with strong financial secrecy laws. In 2025, they're more sophisticated than ever, now catering to crypto investors, AI companies, and digital nomads. Classic names like the Cayman Islands, Bermuda, and Jersey still make the list, but now places like United Arab Emirates, especially Dubai, Singapore, and even parts of the US like Delaware continue to attract global wealth. The key features of tax havens remain the same: low or zero tax rates, anonymity through shell companies and trusts, and financial privacy. What has changed is how technology and legal innovation have made the processes more seamless and harder to trace. A tax haven is a place where people or businesses can legally reduce the amount of tax they pay, often by moving their money there on paper, even if they don't actually live or operate in that country. These places offer very low or even zero tax rate, making them attractive to the wealthy and large companies looking to protect their profits. But it's not just about low taxes. Tax havens also provide privacy. They often allow people to hide their identities using shell companies or trusts, making it hard for tax authorities in other countries to track who owns what. For example, a company in the UK might say it's based in the Cayman Islands, even though its real offices are in London. On paper, it shifts its profits to the Cayman Islands to avoid paying the UK's higher rate of tax. The company isn't breaking the law, it's using legal loopholes, but this kind of behaviour means countries like the UK lose billions in potential tax income. Profit shifting. Let's talk about profit shifting. That's when companies book profits in low-tax countries instead of where their sales actually take place. Take a UK-based AI startup, for instance. It might set up a holding company in Ireland and transfer all its intellectual property, like its machine learning code and algorithms, to that Irish entity. Then, instead of paying the UK's 25% corporate tax rate, they pay Ireland's 12.5%, or often even less thanks to tax incentives. The UK branch then pays the Irish company hefty royalties to use the intellectual property, effectively transferring profits offshore while slashing their UK tax bill. In 2024, the EU estimated that it loses around 150 billion euros each year to this kind of aggressive tax planning. Meanwhile, big players like Meta, Amazon, Google, and Tesla continue to use variations of these schemes. One notable example is Starbucks. The company has historically employed intra-company transactions to reduce its tax liabilities in the UK. For example, Starbucks UK paid royalties to a Dutch subsidiary for the use of the brand name and purchased coffee beans through a Swiss arm, both of which helped move money out of the UK, where the corporate tax rate ranged from 31% in 1998 to 24% by 2012, to Switzerland, where combined federal and cantonal tax rates in low-tax cantons like Zug were approximately 11.85%. This strategy allowed Starbucks to significantly reduce its UK tax bill by shifting profits to countries with lower tax rates. These practices, while legal, have attracted significant public and governmental scrutiny. Starbucks' tax strategies led to major controversy, especially after it was revealed that the company had only paid $8.6 million in UK corporation tax over 14 years, despite generating over £3 billion in sales. That's an eye-watering amount of sales, making it all the more shocking that Starbucks only paid £8.6 million in corporation tax between 1998 and 2012. By inflating the costs paid to its own overseas subsidiaries, Starbucks was able to drastically reduce its UK taxable profits despite strong revenues. The controversy erupted in 2012 when the story broke and quickly captured national headlines and public outrage. In response to public pressure and a parliamentary inquiry, Starbucks voluntarily agreed to pay £20 million in UK taxes over 2 years, acknowledging the need to address public concerns. High net worth individuals' income tax. It's not just corporations. High net worth individuals also exploit tax havens, but their tools rules are different. One method is migration. In 2024, the United Arab Emirates, particularly Dubai, attracted the highest number of new millionaires globally. According to Henley & Partners, the UAE saw a net inflow of approximately 6,700 high net worth individuals, surpassing all other countries in millionaire migration. In 2025, Dubai remains a favourite for the ultra-rich due to its 0% income tax, luxury lifestyle, and favourable residency rules. While Portugal's Golden Visa program has recently been restricted, countries like Monaco and the Bahamas continue to offer attractive terms for those seeking wealth-friendly jurisdictions. Although Dubai experienced the most influx of millionaires in 2024, other countries witnessed a sharp decline. The UK, for example, saw a net loss of about 9,500 millionaires in 2024, the second largest outflow globally, only surpassed by China, which suffered the world's greatest high net worth individuals exodus, with approximately 15,200 millionaires departing. This unprecedented British exodus, more than double the 4,200 who left in 2023, has been linked to political and fiscal shifts, including the abolishment of the non-dom tax status, rising economic uncertainty, and the introduction of the Labour government. These changes have made the UK increasingly unattractive to the ultra-wealthy, prompting many to seek out jurisdictions with lower tax burdens and greater financial security. Crypto investors are another major group. After the 2021 and 2022 crypto booms, many early investors moved to jurisdictions with friendly crypto tax laws. Places like El Salvador and the Bahamas became hubs for Bitcoin millionaires hoping to avoid capital gains taxes. Then there are trusts. These legal structures allow individuals to move assets out of their personal name into the hands of offshore trustees. On paper, the trustees control the money. In practice, the beneficiary, usually the original owner, retains access. Example: a UK resident puts a yacht into a trust registered in the British Virgin Islands. The yacht is now owned by the trust, not the individual. Legally, the UK tax authorities can't touch it. Meanwhile, the owner still uses it whenever they want. And while income distributions from the trust may be taxed, capital gains and interest income often go untouched. The result is a legal form of tax invisibility. UK taxes. In the lead up to the Brexit referendum, there was widespread speculation that the UK might pivot toward becoming a low-tax, deregulated haven to remain globally competitive outside the European Union. Some economists and politicians even floated the idea of a Singapore-on-Thames model, where the UK would attract investment through aggressive tax incentives and light-touch regulation. But nearly a decade later, the reality has been quite different. Rather than slashing taxes, the UK has implemented a series of tax freezes and hikes, resulting in the highest tax burden in over 70 years. In other words, while the rhetoric hinted at a future as a tax haven, the policy direction has gone the opposite way. That said, certain features commonly associated with tax havens still persist. Beyond mainland Britain, the UK's crown dependencies, Jersey, Guernsey, and the Isle of Man, continue to act as offshore financial centres. These small islands offer low or zero corporation tax rates and attract billions in global capital. While technically self-governing, they're closely tied to the UK and benefit from its legal and financial infrastructure. Many UK-based investors and firms route funds through these jurisdictions to minimise tax liability. How the UK can deal with tax havens. If the UK wants to reduce the growing tax burden on its workers while strengthening the economy, it must become a place that attracts businesses rather than pushes them away. That starts with offering a fair and strategic corporate tax rate, one that's low enough to be competitive globally, but high enough to ensure companies are contributing their fair share. Right now, tech giants like Apple, Meta, Google, and Microsoft choose to base their European operations in places like Ireland, not simply for talent or geography, but because Ireland offers a 12.5% corporate tax rate and additional incentives that slash effective tax rates even lower. The UK could take a bold step forward by offering a flat 9% corporate tax rate to qualifying companies that choose to establish their base in the UK and report their profits here. This isn't about cutting taxes to zero. It's about strategically competing. A 9% tax on billions in revenues means HMRC collects far more than it does today when companies shift profits offshore and pay next to nothing. For example, 9% of 1 billion is 90 million in tax revenue, money that could go toward public services and infrastructure. But the benefits don't stop at tax revenue. If these companies move significant operations to the UK, they would create thousands of jobs, from engineers and developers to marketers, lawyers, and support staff. Each headquarters or research and development centre based in the UK would spark growth in local economies, boosting housing, retail, hospitality, and transportation in cities like London, Manchester, Birmingham, or Leeds. Beyond direct employment, there's a multiplier effect. Large firms often nurture startup ecosystems around them. Smaller tech companies, service providers, and freelancers thrive in the orbit of big players. Universities benefit from research partnerships. Young graduates are more more likely to stay in the country if high-paying, high-skilled jobs are available locally. It's not just companies who notice tax environments. Talented workers do too. If the UK becomes known as a high-tax, low-opportunity economy, it risks losing skilled professionals to countries with more favourable conditions. But if corporate contributions increase through smart policy, the government can afford to lower income taxes, reduce national insurance, and lift thresholds, giving relief to workers whether they earn £25,000 or £500,000 a year. In short, a fair and competitive corporate tax rate doesn't just boost government revenue. It creates jobs, drives innovation, strengthens the economy, and sets the stage for lower taxes for everyone. It's a long-term investment in a future where the system works not just for the ultra-wealthy, but for ordinary working people too.